Why you need to buy gold now. The $2 trillion tsunami nobody sees coming. Gold surged 50% before 2008. 6 months later, financial collapse. It did it in 1973, again in 1980, and again in 2008. Every single time, a crisis followed. This pattern has never been wrong. It just did it again. But here's what makes this time different. This time, there's something happening behind the scenes that most people have no idea about. Something that happened in July 2025 that fundamentally changed gold's role in the global financial system forever. I'm talking about $2 trillion in institutional money about to flood into gold. Not retail investors buying coins, not fear-driven speculation. I'm talking about central banks, pension funds, and sovereign wealth funds legally required to dramatically increase their gold holdings over the next few years. Before we dive in, smash that like button and subscribe if you want to stay ahead of market moves like this. Drop a comment with your city and tell me if you're already positioned in gold, or if this is news to you. I want to see how global this community is. This isn't theory. This is documented policy change. And once you see what's actually happening, you'll understand why the window to position yourself is closing fast. Section 1. What's happening right now? In July 2025, something quietly changed in the global banking system. Gold was reclassified under Basel III regulations from a Tier 3 asset to a Tier 1 asset. Here's what that actually means. For decades, if a bank held $1 billion worth of gold, they could only count about half of that value on their balance sheet. The system was designed to keep gold as something banks stored but never used. Basel III changed everything. Now banks can recognize 100% of gold's value. But here's where it gets interesting. The next step is what's called HQLA status, high-quality liquid asset. When gold becomes HQLA, which many analysts believe will happen within the next 18 to 36 months, it won't just be a store of value anymore. It will become actual collateral that banks can use for lending, for repo markets, for the entire global financial system. Gold will go from sitting in vaults gathering dust to becoming an active participant in how the world finances itself. And China knows this. While everyone's been watching stock markets hit all-time highs, China has been executing the most aggressive gold accumulation strategy in modern history. Look at this chart. For years, China's gold holdings barely moved. Then something changed. The moment Trump's first administration started tariff threats, China's gold purchases exploded. They're not hiding this. They're doing it publicly, telegraphing to the entire world that they're building an alternative to the dollar system. But China didn't stop there. They built what's now being called the Gold Corridor, a network of vaults across Asia, the Middle East, and Africa, all connected to the Shanghai Gold Exchange. Think of it like a physical blockchain for gold. Every bar tracked, every serial number verified, custody geographically decentralized. Here's why this matters. For years, China tried to get other countries to use the yuan for trade. And everyone said the same thing. We don't trust you to hold our gold in China. The Gold Corridor solves that problem. Now countries can hold yuan, backed by gold, stored in their own region, verifiable and redeemable at any time. China just solved the trust problem that has kept the dollar as the world's reserve currency for 80 years. Meanwhile, Russia's central bank is now one of the largest gold holders in the world. India is stacking gold at record levels. Central banks globally bought over 1,000 tons of gold in both 2022 and 2023, the two highest years on record. Section 2. Why this time is different. Every time I mention gold, someone says, yeah, but Peter Schiff has been saying this for 20 years. Fair point. But this time isn't about inflation fears or generic safe haven demand. This time is about structural change in how the global financial system operates. Remember when Russia's $300 billion in foreign reserves got frozen in 2022? That sent a message to every country in the world. If your reserves are held in dollars, they're not really yours. They can be seized with a click of a button. That's when the trust started breaking down, not just in emerging markets, but everywhere. Because if the US can freeze a nuclear power's reserves, what stops them from freezing yours if you disagree politically? Gold can't be frozen, can't be printed, can't be sanctioned. It doesn't require permission from Washington to move or use. This is the same psychological shift that happened in the 1970s when Nixon closed the gold window. The dollar was detached from gold, and suddenly there was no anchor, no limit on money creation. What followed was a decade of chaos. Gold went from $35 an ounce to over $800, a 2,000% gain. But gold wasn't becoming more valuable. The dollar was collapsing. The yardstick we measure everything against was being stretched thinner and thinner. We're in the same moment right now. Except this time, the debt is 10 times larger. Federal debt now exceeds GDP for the first time since World War II. And unlike the 1940s, there's no post-war economic boom coming to pay it down. The ship is taking on water, and we're rearranging deck chairs. But here's what makes this moment unprecedented. We're not just seeing a flight to safety. We're seeing the emergence of a multi-monetary world. China and the BRICS building a gold-backed system on one side. The US trying to maintain dollar dominance on the other. Both sides are buying gold. Both sides are preparing for a post-dollar dominance future. And that preparation is creating demand that most investors aren't even tracking yet. Section 3. The numbers. Let me show you why $2 trillion is not hyperbole. Right now, institutional investors like central banks, sovereign wealth funds, and pension funds hold about 20% of their reserves in gold or gold-equivalent hard assets. New guidelines being published by major financial institutions are now recommending that allocation should be closer to 30%. That's a 10% difference. Doesn't sound like much, but across the entire global financial system, that 10% shift represents approximately $2 trillion in new demand. And here's the thing about gold. You can't print more of it. You can't manufacture it. Global gold production is relatively fixed. All the gold ever mined in human history would fit in a cube about 70 feet on each side. So when $2 trillion in new demand hits a fixed supply, the mathematics are unavoidable. Price has to adjust upward, significantly upward. Some analysts are projecting gold could double from current levels within 5 years. I'm not making that prediction myself, but the mathematical logic is sound. Let me put this in perspective. If you own $100,000 in gold today and it appreciates 20% over 2 years, you have $120,000. Minus storage and insurance costs, maybe 2% annually, your real gain is around $16,000. But if gold moves according to the structural drivers we're discussing, and institutional money flows in at the pace Basel III changes suggest, that same $100,000 could generate substantially different returns. The key difference isn't speculation. It's that this demand is being driven by regulatory changes and geopolitical realignment, not retail fear. Look at what's already happening. The US just repatriated significant gold holdings from London back to American soil. The official story was about tariffs or audits. But think about the real reason. If the world is moving toward a system where gold physically moves and custody becomes critical, then whoever controls more physical gold has more power to influence the next financial system. The US holds roughly 8,000 tons of gold, the largest official stash in the world. But bringing it back home signals they see what's coming. This isn't about whether gold will go up. This is about understanding that we're in the early stages of a global monetary reset. And in a reset, the assets that anchor the system become exponentially more valuable than the assets that float on top of it. Gold is the anchor. Everything else is floating. Section 4. The window is closing. Here's the part that should get your attention. European retail investors, some of the most sophisticated in the world, sold gold at a 17-year low in 2024. Meanwhile, American retail investors bought more gold than any year since 1979. Think about that divergence. Professional European money flowing out while amateur American money flows in. Except this time, both are actually right. But for different reasons. Europeans were selling physical gold to buy gold mining stocks, gold ETFs, and positions in the gold ecosystem that provide leverage and cash flow. They're not bearish on gold. They're getting more sophisticated about how they own it. Americans are buying physical gold because they finally understand the trust problem. They're late to the party, but they're not wrong. The real opportunity is understanding what comes before HQLA classification. Right now, gold is Tier 1. When it becomes HQLA, which could happen within 18 to 36 months, the institutional flood begins. That's your window. After HQLA classification, after $2 trillion starts flowing, after every major institution has already positioned, the price will reflect the new reality. You want to be positioned before that happens, not after. This is the same pattern that played out before every major commodity reclassification in modern financial history. The smart money positions early. The headlines come later. The late retail money comes last. Right now we're between smart money and headlines. The Basel III changes are done. The gold corridor is built. Central banks are buying at record pace, but most retail investors still don't understand why. By the time CNBC is running 24/7 gold coverage, and your neighbor is asking how to buy gold, you'll be glad you positioned before the noise started. Section 5. What to do. I'm not a financial advisor. This isn't financial advice. But here's how I'm thinking about it. Gold should be part of a diversified portfolio, not the entire portfolio. The question is, what percentage makes sense given the structural changes we're discussing? Physical gold provides security but has storage costs. Gold ETFs provide liquidity but counterparty risk. Gold mining stocks provide leverage but company-specific risk. The sophisticated approach is probably a combination. Some physical for true wealth preservation, some ETFs for liquidity and trading, maybe some mining exposure for leverage if you understand the sector. But the key is understanding this isn't speculation. This is positioning for documented regulatory changes and geopolitical realignment. Gold isn't becoming more valuable. The dollar system is becoming less trustworthy. And when trust erodes in a reserve currency, everything priced in that currency loses purchasing power. Your salary, your savings, your retirement account, everything. Gold is how you protect against that erosion, while the world figures out what comes next. The pattern has already played out. Gold surged 50% before every major crisis in the last 50 years. It just did it again. But this time, the underlying driver is bigger than fear. It's bigger than inflation. It's a fundamental restructuring of the global monetary system. And that restructuring has already begun. Drop a comment right now. Tell me if you're already positioned in gold, or if this is the first time you're hearing about Basel III in the gold corridor. I genuinely want to know where this community stands. Hit subscribe, because we're going to keep tracking this story as it unfolds. The smart money has already moved. The question is whether you'll move before the headlines do. I'll see you in the next one.